There was a big debate a few years ago on celebrating failure or not. I am not celebrating failure. I'm not saying, hey, I should fail to learn and I'm proud of my failures. No, I'm proud of my learnings and I'm accepting failure
Exactly.
as part of the journey. It's not good to fail, but
Absolutely.
if it's part of the learning curve, a part of the learning journey, why not?
That was the voice of Ahmad Takatkah, the VCpreneur. I am your host, Ali Zwail, and this is the Startups Arabia podcast, where you learn about the Arab startups ecosystem from the best founders, investors, and operators in the region. Welcome. My guest today is Ahmad Takatkah. Ahmad is a technical founder turned VC with background in computer engineering, data science, and product management. Over the past 15 years, he's helped set up and operate 3 VC firms, for which he created new deal sourcing, startup evaluation, and exit prediction tools. He's built a new AI model based on startups' data that summarizes startup pitch decks and prepares investment memos and DD reports, used ML to score companies based on price, market, team differentiation, and performance, and to predict exit timelines, valuations, and fund returns. Ahmed is working on several things right now: a fund, as you might expect, his own startup, a podcast, and he's just published a book. So it's a very wide-ranging interview where he talks about technical to entrepreneurial to active VC investing experience, both in this region and in Silicon Valley. He's an engineer with an MBA and a Kaufman Fellow since 2012. So I know you're going to enjoy this conversation. Welcome to the Startups Arabia podcast, where I'm happy to host today Ahmad Takatkah, the VCpreneur. And that title is not a coincidence. He has an eclectic mix of talents, skills, and roles. So he is, as you may have guessed already, a VC and an entrepreneur. But he's also a podcaster. He's a blogger. He's the author of a recent book that we're definitely going to talk about, which kind of covers the A to Z of venture capital. VC Evolve is the name of the book, and many other things. So without further ado, welcome, Ahmed.
Thank you for having me, Ali.
So, Ahmed, maybe we can just start in a few minutes talking about your path into startups and you know how you came to be in this wonderful ecosystem of startups.
Wow, it's all over the place. Okay, so I started my career after graduation. I studied electronics engineering, by the way. And right after college, I joined the Jordanian TV as a studio system engineer. I lasted for barely a year, and it was a very boring job, as you can maybe imagine. My job was to sit in a very far room from the studio, from where the action is, and I just watch the devices. If anything goes wrong, I pick up the device, take it to the shop to fix it, and then bring it back. That's mainly my day-to-day job. Now, to be fair, in addition to that, engineers in that entity were also responsible for designing the whole studio system, maintaining it, upgrading it. We used to attend lots of courses or conferences for us to learn more about the new equipments that we can use. But in a nutshell, it was on a day-to-day basis, it was very boring. So that triggered me to basically say, okay, this is not the future I wanted for myself. Let me try to do something else. With that, I actually started looking at other opportunities. One of them was there was a business plan competition. It was not called startup competition at the time. It was a business plan for Princess Sumaya University, the university I went to. So me and my friend, we applied to that competition. We won the 4th place. And this meant we got some cash from the reward. And then with that cash, we said, okay, let's start a company. We raised some angel investment, a very small amount. That was in 2000, I would say 2005, 2006. And we started a company, Train Dex, which is, again, the name was not that good as well. But anyway, the idea was to create a marketplace for training courses in Jordan. So you're a training seeker, you come to our website, you search, and you find every training course that is listed in any training center in Jordan. And then you select the course you want, you read reviews, of course, about that course, the price, the timing, everything. Then you go to the training center and register there and pay there. You can guess the problem here in the business model. There is no online payment. Again, 2005, 2006 was really tough to get online payment. So we proved that business model doesn't work, and we learned a lot. We used to go and seek advice from everyone, and every time we get an advice from someone, we say, oh my God, this person is the best. He or she knows everything about this business. We should follow their advice. And then before, taking it to a maturity level, we go to another person, and that person gives us a conflicting advice, and we follow that person, and then a third, a fourth, a fifth. It was a chaos. But anyway, we learned a lot
Trial
from
by
there.
fire.
Yeah. After that, after a year, we decided to shut down the company. We actually received an acqui-hire offer from Byte.com at the time.
Oh, nice.
From Rabi Ataya. But we were like, no, acqui-hire? No, we want full acquisition. We want to go big. Anyway, I wish we accepted that offer. After that, I joined the Arab Science and Technology Foundation. And in there, my job was to do matchmaking between founders and investors. At the time, we didn't have a lot of VC investors. We just said investors. And that included both types of angel investors and VC firms. That was, I think, 2007, 2008, until early 2009. And in ASTIF, Arab Science and Technology Foundation, we were a regional organization. I think the headquarters were in Sharjah, but we did events, matchmaking events and conferences in Egypt. I remember in, I think, Smart City or Nile City. I can't
Smart
remember
Village.
the detail. Smart Village,
Probably.
yeah. West of Cairo.
Yep.
West of Cairo, yeah. We did events in Saudi, Dubai, Kuwait, and of course in Jordan. And that was kind of my very first introduction to the actual work of venture capital. And if you know, Y Combinator came up in maybe late 2008, 2009, early 2009. I learned about that model and I was fascinated by this model. And I'm like, okay, we need to create something like that in the MENA region. I didn't have any experience yet. I started a company that failed, and I worked in a matchmaking company. I used to call myself Khattaba. I find
right.
The companies and the investors.
Yep.
I wanted to do something similar to Y Combinator at the time. And I started talking to those investors. I started to build connections or relations with. And one of them was Rashid Al-Ballar, and he was starting N2V. I don't know if you're familiar with the story of N2V.
I'm familiar with N2V, but not the story.
Okay. So that was in 2009, I think mid 2009, where he said, Ahmad, I don't know if that model can work as is in the Middle East region. Rashid's vision was, hey, let's see what's happening around the world, take whatever that fits us, and try to customize what doesn't fit our economics, our culture, our limited resources, etc. And he promised me experimentation, and he delivered. Boy, we did a lot of experimentation at N2V. We started with a few people, and we grew the company within 3 years to become I don't know, maybe 300, 400 people in 4 cities in Amman, Cairo, Riyadh, and Dubai. We invested in companies as a venture arm, like we created a venture arm to invest in companies. We created an accelerator for mobile applications. We um, we acquired some companies, and we built some companies internally. Like we created a venture studio, kind of a venture studio. The idea was to create something like Idea Lab, a big internet holding company that builds companies, invests in companies, or acquires majority stakes in other companies, etc., and provides infrastructure. Like we have content creation arm, we have advertising arm, payment arm, etc., and then take the whole thing public. Obviously, that didn't work. It was maybe too early, or the model itself was not the perfect fit for the market at the time. I think I worked at Into V 2009, 10, 11, and mid 12. I think I left. By that time, I went to Harvard to attend an executive program on venture capital and private equity. I started my Kaufman program. Kaufman Fellowship is a 2-year venture capital educational program based in Palo Alto. Used to, I think now they moved the headquarters. It's one of the top VC educational programs. It's not only technical, it's technical and behavioral. And above all, you build a very big, powerful network of other VCs in the world. I think we're now 700 VCs in the Kaufman Fellows, and they're running, I don't know, class 27, 28. I was class 17. That was in 2012. So by the time I left N2V, I thought I had enough experience to start my own VC firm. And I called it Sinbad Ventures or Sindibad Ventures. And because of the Kaufman Fellows, I used to go every 3 months to Silicon Valley for a week to attend classes in there. And I developed this relationship with Black Box VC. It's started by Fadi Bshara, Syrian American, who started an accelerator in the Bay Area for immigrant founders. And I was like, perfect. I can bring you founders from the Middle East region and you take care of them here. You introduce them to your network of investors. You give them this 3 months educational program or training program on how to scale, it's like an accelerator. And it was a perfect marriage between Sindibad Ventures and Black Box VC. And I wanted to raise a small fund to just do that. I talked to multiple LPs over, I think, a year. It didn't really click. Maybe I was still too early in my career. Maybe the region was not ready for that. Again, we're talking 2012. At the time, we had only a few VC firms I can remember. Of course, many of them are still here. For example, MEVP, one of the pioneers. Beco Capital, I think, either started at that year or started a few years ago or back before I wanted to start Sindibad Ventures. I think we had Oasis 500, of course, and some others.
Yep.
So at the time, long story short, I couldn't raise the fund. And then after that, I think I was known for someone who had relatively good experience at N2V, and someone who started or tried to raise a fund. And then after that, I was already خلاص in the venture capital industry. So that may be a long answer to the question, how did you get into VC?
Yeah, so it is, and it's there are so many touch off points that we could pursue, but maybe I'll actually do something different, which is to jump all the way to the present and ask you to tell me about what you're doing these days, because there are like several parallel paths that are happening, and maybe we can talk about them.
Well, to talk about what's happening now, it's really hard because I'm doing multiple things and I don't know which one. Okay, so maybe the main thing I'm working on right now is reconnecting with investors and founders in the region. I immigrated to the US for 10 years, I think, late 2015, early 2016. And I came back a few months ago and I wanted to reconnect with everyone and make new connections, learn more about the new VC firms here, meet all of the VCs in here, meet more founders in here. So I said, what's the best way to reconnect and meet new people? Of course, you can go and attend events and all of that, but I said, why not create a podcast? And that podcast was, the idea was, I want to meet the highest number of people I can, and at the same time add as much value as we can or as I can to the ecosystem, to the founders mainly. And I said, okay, why? I'm inspired by All In podcast, of course. I said, okay, I will create this podcast where I host three VCs, three different VCs every time to react on the startups news of the week. And let's do that weekly. So at one point, or on one side, the founders would see all those VCs, and hopefully we'll have as many VCs as we can over the course of the season one. Founders will see those VCs talking and reacting to news. They learn more about their personalities, their characters, the way they think, the way they react to news. And I ask specific questions about the companies in the news or in the stories, but I also ask general questions. So this is a good way for a founder. If they watch 10, 15 episodes, they can learn a lot about many VCs in the MENA region. And for me, for my personal agenda, I would meet those new VCs and build this connection. So this is how the idea of VC React was born. And I noticed a really good news aggregator, Forward Start, started by Jamie and Zoe, their co-founders. And I reached out to them saying, hey, I'm thinking about this idea for a podcast, just reacting to news in a very casual conversations, like a Zoom call. We're just talking about the news in a Zoom call. And he really liked the idea. I said, you bring the news, we co-host together, and we host these VCs every week, and we see how it goes. And alhamdulillah, we received really good feedback, and that kept us going. Now I think we're episode 12, which means it's been 3 months doing this podcast.
Yep.
So that's one thing I'm doing. Another thing I'm doing over my, 15 years of venture career, I worked as an operator. I worked at Carta, at King's Crowd. I learned more about secondaries. I learned about crowdfunding. I learned about data science because I took a detour when I moved to the States from venture capital to data science, and then came back to venture capital through King's Crowd Capital. So I learned a lot of things within that area, not necessarily direct primary VC investments. There are other alternatives. And two of these alternatives attracted my attention when I came back to the region, and I wanted to focus on them. One of them is secondaries. The other thing is revenue-based financing.
Got it.
And I'll talk a little bit about each of these. For revenue-based financing, because I focused on data and data-driven investing and data analysis, data science, in Carta and in King's Crowd for, let's say, 7 years, I noticed the need for the science part of venture capital. Because, this debate, venture is science, more science than art, or more art than science. I say it's both, but I wanted to focus more on the science part, at least
the data-driven part, basically.
The data-driven part, especially because when I first moved to the US, I noticed that the top tier VC firms they started hiring data scientists. They started having data science teams, and they started collecting a lot of data. And there's a lot of examples about that. But I said, okay, I want to become more of a data-driven investor and an operator in a company in Silicon Valley. So I said, I want to learn data science. I have a technical background. Let's go back to school, but online school, Udacity. I took 2 nano degrees in Udacity. Each one is 6 months. First one was data analysis. The second one was machine learning and data science. And during that time, I was trying to find a job where I can apply those new skills I'm learning, but not in any application. I wanted specifically data on startups and investors. And I kept applying to companies like Carta or eShares at the time. And then they changed the name to Carta, Crunchbase, AngelList, CB Insights, DataFox, I think. I focused on these 5 companies, started sending them cold emails, spamming them until they replied. One of them replied, which was Carta. And I got an internship in Carta for a data science or data analyst position. But the good news was my manager in there was a PhD data science from Stanford. So you can imagine how much I learned from that person. But anyway, in Carta, I learned more about data science. I learned more about secondaries, especially towards the end of my career in Carta when we started talking about Carta X and launching Carta X. In King's Crowd, I applied all of that knowledge. In King's Crowd, they wanted someone with those 2 experiences, data science and
Right.
venture. Because Chris, the founder of King's Crowd, he wanted to create a data-driven way to evaluate and score companies listed on equity crowdfunding websites. Anyway, I applied all this knowledge. I created algorithms to evaluate companies and score them. And then we created an algorithm to, or actually we started a fund, a quantitative fund that's focused on the data that we collect on these companies. So it's not a typical VC fund. Again, we call it a quant VC fund because 70% of the work is done by the machine and only the remaining 30% is done by us. The fund is doing very well. As I mentioned, maybe before we started recording, Zencaster is one of our portfolio companies, and that company, the platform you're using to record now. And we invested in many other companies. But anyway, back to what I'm focusing on today.
Yeah, I mean, I guess because you're still in King's Crowd, so it's kind of today as well. So it's a different kind of venture approach. So if you can tell me more about King's Crowd, as now that since we started talking about it, and then we can go back to D1 and Revenue. I mean, how is it different? How do you guys take decisions? And how big is the fund? And what's the thesis?
Yeah, sure. So in the US, crowdfunding is much more active, or specifically equity crowdfunding is way more active than in the region. And the regulations help a lot. As a company, as a startup, you can raise up to $5 million from the crowds or from crowd investors or retail investors, not necessarily accredited investors, right? So anyone can invest $200 there, $300 here. So it's very easy. And you can do this every year. There are other regulations like Regulation A, where you can raise up to 20 or even $75 million, but that needs audited financials. It's a longer process, but it's still doable. And in King's Crowd, we did both. And so when you have regulations preparing all this for companies to raise money and giving licenses to platforms to help companies list on these platforms, you will get an explosion of platforms. Like there are 70 platforms that at least I know about, we know about in King's Crowd, that for equity crowdfunding. On these platforms, you would get anywhere between 50 to 60 new companies listed on these platforms every week. So as a retail investor or a crowd investor, when you want to invest in one of these companies, Do you have to, you actually have to go to, if you want to see everyone, you have to go to all these 70 platforms and look at all of these companies and dig deeper into the backgrounds of the founders, look at the industries that they're working on, the markets. And, there's a lot of work to do. Even for a professional VC investor, it's a lot of work to do, right? So we said, we can't really do this. We need the machine to help us do this. So we started collecting data. At the beginning, very humble beginnings, we started collecting I don't know, maybe 100 data points. And then that grew to 200, 300, now maybe more. We collect all these data points, and after collecting them, we feed them to, we started with a simple statistical model. We started on Excel or Google Sheets to start comparing these companies to either each other or to a benchmark. Now, to a benchmark, it's really hard because they come from all industries. So it was really hard to get benchmarks, deep benchmarks for every industry. So we said, let's compare these companies to each other. So we created a relative scoring mechanism where we wanted to answer this question. Out of the companies that are available for me as a retail investor now, which one is better?
Right.
And that was the core philosophy behind our scoring system. So we said, okay, let's start this scoring system and watch the results of how well the companies will do after we score them. I think after 2 years, we started noticing that the companies that scored high on our system, of course, our system started getting smarter. We started introducing machine learning, and then ChatGPT came on, and we started introducing AI. But anyway, after 2 to 2.5 years, we said, okay, let's see the results. And we were really happy to see that if you're a retail investor, and if you have invested according to the high score companies or the recommendations of our algorithm, you would have created an alpha in the market. The average unrealized returns for your portfolio would be higher than an average investor who's investing in companies without any recommendations from our algorithm. So we said, okay, this is great
as
news.
compared to the market average, right? Or as compared
to the market
random...
average, yes. To the market average returns. And it was a really good alpha, like 30% higher than the market average returns. We said, okay, perfect, let's start a fund. And we announced that we at Kingscrowd, we want to create a fund based on our those smart algorithms. And we filled the fund from our own customers. Like in Kingscrowd, we have customers who come. The business model of Kingscrowd is basically, we're a research company. We provide you with the scores, the research, investment memos, and reports on every company so that you come and read all this and then make your informed decision to invest. And people would pay us like $30 a month to access all of this data. Of course, there's tiers of subscriptions. There's like 15, 30, whatever.
Right.
But we announced the fund to our own customers, and we filled the fund from our own customers. It's a small fund, $10 million. This is Fund 1 for Kingscrowd Capital. And we started investing. Now I think we have more than 40 companies in our portfolio. And there's multiple things in this concepts in this fund that we wanted to experiment with. The first one is, of course, the quantitative approach.
Right.
We score the companies, and any company that scores 4 and above is considered for the fund. And then the partners meet, and the team and at Kingscrowd, we talk to the founders, and within a week we make a decision. It's very quick. The other thing is that it's kind of an index fund, but it's not. It's why? Because we said we want to invest in the top 100 companies over the next 3 years. So it's a big portfolio fund, smaller amounts,
right,
just to cover more grounds. And so the two main concept is index fund, quant fund. Again, I can't say it's an index fund because it's not, but it's almost an index fund because you're investing in the top 100 companies in this equity crowdfunding industry over an extended period of time of 3 years. But anyway, so the idea here is because we read a lot of, again, we're data driven, and the data and the research in the market stated that the portfolios that have higher number of startups achieved on average higher overall returns for the fund.
Okay.
And we wanted to follow that approach.
For other funds, you mean? Like
for other funds, yeah. And we
right.
wanted to follow that approach and see what happens.
Got it.
And we were very transparent with our LPs who are customers in King's Route. We said, hey, we're going to do this and experiment with all these ideas. And they all loved it. And they said, yeah, we want to invest and participate in this experiment.
Yeah, my kind of people. So, okay. So going back to the present and secondaries in the region, I'm getting that this is like secondaries in the region, not a global secondaries fund with Diwan. Or is it?
Okay.
Yeah.
So
tell me more.
So, yeah, one second. So in King's Crowd, I experimented and I worked and in the data-driven VC passion that I still have. Now I left King's Crowd, the company. I'm still with King's Crowd, the fund. So King's Crowd Capital. I'm still a partner in the fund, Fund One, and I still attend partner meetings almost every week for King's Crowd Capital. But that's remote. The main compensation for me is the carry for the fund. So I'm still working with the partners in King's Crowd Capital. That's one thing. The other thing I'm very interested in is revenue-based financing. Why? Because it is data heavy. In revenue-based financing, it's not like SME financing. You're giving loans to startup companies with high margins. We're talking 50 and above gross margins. And the way to secure the loan is not by, hey, write a personal check or I take warrants like venture debt. Although these things happen in our region because there's no other alternatives, but the core idea of revenue-based financing is mainly, hey, I take your data, I study them, analyze them over the past 6, 9, 12 months, and create a model to predict your revenues for the next 3, 6, 9 months, whatever your loan is. And based on the analysis I do, the thorough analysis of the data I do, based on my models, I decide if I want to give you the loan, that's one. Two, how much of a loan I give you, what's the interest rate on that loan, how long are you going to take to pay back that loan, and what percentage of your revenues should I take to pay back the loan? Because in revenue-based financing, the companies don't pay you a fixed amount of money every month.
Yep.
Yeah, they pay you a percentage of the revenue. So you go up with them, you go down with them. This can drag for multiple months if the company's revenues went down, or can be shorter if the company grew faster. So it's very data heavy, and it's working with startups, tech startups, not SMEs or restaurants or anything else. So that was something I really wanted to work on. So I'm helping Arzan VC now and starting their debt arm, starting with revenue-based financing. And we called it Revenue.com. We're still working on the structure, the model, hiring the team. It's not really announced yet, it's not really operational yet. We're working on all the details. It is now, yeah, it's not operational. But I talked about it in events I attended. So I'm working on that as a managing partner for that debt fund for Arzan VC. So this is the main thing I'm working on right now, in addition to my part-time role at King's Route Capital. And there's another passion that I wish I can work on in the future, which is secondaries funds. direct secondaries, not LP secondaries. So in direct secondaries, you buy shares, not invest in companies. No, you buy shares from shareholders who are either angel investors or previous VCs who want to exit, like pre-seed, seed VCs, or, which is more interesting for me, you buy shares from founders and early employees in the companies. The biggest inspiration and example for me is 137 Ventures in the US. This is how they started. Other secondaries funds are, for example, Manhattan Venture Partners. There's Industry Ventures. They manage $6 billion of assets under management, and they do both direct secondaries and LP secondaries. But yeah, that's another passion I love. Oh, you wanted to push back on something.
Yeah, yeah, and I also want to talk about the secondaries because I mean this was, and then we can go back to revenue maybe. Yeah, that was like this is a big problem. And Carta X, for example, I mean, you've heard, of course, seen the blowback on Carta X, and all the issues that came up with that, and nobody's really been able to pull off. In a retail sense, but there have been some great funds, as you just mentioned, that are doing a really good job of it. For me personally, I would love to have a retail thing. I remember when COVID started, I was like, and Airbnb got a down round. I thought the best investment would be to have to be able to buy secondaries at that down round because I knew they were, Airbnb was already getting ready to IPO and COVID was going to end and everybody was actually going to travel more probably because of what happened with COVID. So I really wanted to get in, but I didn't. Well, I didn't have capital in the first place, but that's a secondary issue. But also I didn't really have a way to get access as just a normal person. So I mean, if there's also like some sort of retail play there, that would I think might be very interesting for people who
So
want to
yeah,
benefit.
let's talk about marketplaces for secondaries. That's a big
Yeah,
issue.
yeah, yeah,
So
yeah.
Carta X is still there and it's still very active, but they pivoted from being this public marketplace for secondaries to the private marketplace for secondaries.
Yep.
By that I mean you can't go as a retail investor to invest in private stock. You can't buy shares of privately held companies. They're not public yet. There are multiple problems in that model when you talk about public, they're not public, but marketplaces for private companies, right? One of the main problems is price control. You're a privately held company, you're still raising money, you can't let the public decide the price of your company by the supply and demand of the stocks, of the shares, right? That's a big problem for you. You're negotiating valuations with VCs on the next rounds. And how can you do that when your stock is being traded somewhere else on a different price? The other thing is you want control on who is
Ownership.
buying your shares. Ownership, exactly. You want control over your cap table. There is no regulations to regulate all of these privately held companies when it comes to ownership and control on the board, and you want to keep control on the direction of the company. So another thing is information rights. So if I'm a shareholder in a privately held company, do I have information rights or not? It's not listed in the stock market. So the
Yep.
CEO should not give me all that information, especially if there's some sensitive information. So
Exactly.
there's a lot of problems with a marketplace. But what Carta X is doing now, as far as I understand, and again, I'm not representing Carta here, I'm an ex-Carta. My understanding is they're still doing tender offers, which
Hmm.
is private offerings for stocks, whether owned by previous shareholders or owned by employees in the companies, where new investors can come and buy these shares,
Right.
whether it's an independent tender offer or a tender offer in parallel to a new round that the company is raising. And
Hmm.
this model proved to be really good for Carta X. They're doing very well with it.
Yeah. but it still doesn't solve my problem with getting those
It
Airbnb
doesn't.
shares
It
at the right time.
doesn't. No.
Yeah,
Exactly.
yeah. So anyway, going back to revenue, there's been recently, you know, uh, it's nothing has gone public, but there have been when the interest rate situation changed in the world, a lot of companies that raised venture debt had like major problems. I mean, because venture debt was always like spoken about as something that will not dilute your equity but still get you funding to grow and things like that. But it turned out that, you know, there were warrants and there were issues with that. Of course, what you're talking about is revenue shares, so it would potentially not have the same revenue share. Yeah, revenue based financing. So it's a share of the revenue, not a fixed amount. So that would potentially be less risky. But how is this like? Is this risk decreased for founders? Because that's also part of probably their because equity at the end of the day, yes, they lose some part of the cap table, but at least people are with them on the same boat, so to speak.
Yeah. So there are some differences, main differences between venture debt and the revenue-based financing. First of all, we're talking about very, very short-term funding. We're talking about 3 to 9 months. So it's mostly below the 12 months or the model that we're adopting, at least in revenue. There are some other models, of course, but for revenue, the model we're adopting is 3 to 6 months, maybe maximum 9 months. And the uses for revenue-based financing is not to fund the company when it comes to expansion and growing and scaling and paying for salaries and expenses. No, it's a short-term use. There is a season coming up and you need inventory for that season. So you take a small amount of money that could be maybe 1x, 2x, 3x of your monthly revenue. That's it. To get that supply. There's a new product and you need a marketing campaign to promote this new product. Or there's a big event that you want to take a lot of team members to, and it's very expensive to participate in that event or exhibition, and you need a small amount of money to do that. There's an upgrade to your software that you need. It's very expensive and you need it right now. So to do these small little things, it's not fair to lose more equity in my company to get funded for these, right?
Right.
So that's the main uses for revenue-based financing, or at least the model that we're doing in revenue. And for you mentioned interest rate and it's high. For RBF, it's a standard model now across the world. They charge the company anywhere between 1.5 to 2.5% a month. So let's say an average of 2%, and you're taking a loan for 3 months. That would mean 6%. That's it. That's what you're paying. Of course, if you annualize it, it's a little bit higher than the average bank loan. But hey, go get a loan from the bank. They will not depend on your data like we do. They will not predict your future revenues. They will need hard assets as collateral.
Collateral.
And for venture debt is much bigger. They give you millions of dollars, and it's kind of complementary to venture capital uses.
Right.
It's not for those small use cases.
Got it. Yeah, now I understand more, you know, what it's about. Okay, I mean, let's go a bit to your personal experiences before maybe we come back again to Number and VC Evolve. You've been in the ecosystem here across like Jordan, Saudi, and, you know, you've been all over the place. And then you spent almost a decade in the Bay Area, aka Silicon Valley. And so, I mean, what do you feel are the major like cultural differences between the two ecosystems?
Oh my God. Okay, let me take you back to 2014 when I moved from Dubai to Silicon Valley. I wrote a blog post. I called it From Silicon Oasis to Silicon Valley. And I used to live in Silicon. There's an area in Dubai called Silicon Oasis. I used to live there, and I moved to Silicon Valley. And the main differences I found, like it was, of course, I visited Silicon Valley before I moved, but then when you move and start living there, you would expect that it's tech savvy. The area, the region is tech savvy. The very first time I visited Silicon Valley, I was expecting high-rise buildings, futuristic cities, everything is automated. You know, no, it's not.
Yep.
Like
No,
Dubai
it's
is
not.
way more advanced when it comes to real estate and the use of technology and day-to-day things and tasks, way more advanced than Silicon Valley. The infrastructure is amazing in Dubai, in Singapore, and now in Riyadh, and those new cities. Silicon Valley is a very old city, or it's not city, group of cities. San Jose, mainly San Jose, and then San Francisco, and the small towns in between, Palo Alto, Sunnyvale, Mountain View, and,
Yep.
yeah, all of these cities, small cities, Santa Clara. In Silicon Valley, the idea is, hey, I want to create the future. I want to create the next big thing. I want to create the technology that everyone in the world will start using. At that time, in our region, it was, I want to use that new technology. It's not, we want to create it. So that's the main difference here, which is, I mean, both are good. This is futuristic. This is futuristic. For me, I value futuristic approaches. So that was one main difference. The other difference is, investing in bold ideas and moonshots, 0 to 1s. In our region, we're still not there yet. I think, and it's not fair to blame only investors. I would also say the founders, and
I
including
agree.
myself. I was a founder for 2 times. I didn't talk about the second time where I was a founder, and both of them failed. We tend to shy away from those big bold ideas,
Right.
and we're not, maybe, at least talking about myself, I'm not that super technical guy who can move mountains. This is a term or an expression they use in the Bay Area, where I can create a new technology from scratch. And we don't have the same universities they have. We don't have the Stanfords, the UC Berkeleys, where the research of all the new cutting edge technologies are.
Yep.
We have good talents, but we don't have enough support for these talents, maybe. And by support, I don't mean the direct support. I mean the overall ecosystem support to create those entrepreneurs who would come with those new technologies and those VCs who would invest in those bold ideas. Yeah, that's what comes to mind when I talk about the differences between here and there. And I mean, there are other cultural, political, economical differences between both regions, of course, that play a big role in, you know, how people think and react and build for the future.
I'm sure. And I think another thing, and there's a hint of it, like on your LinkedIn profile, where you just mentioned that you have another startup that failed, Decap, and so you proudly on your profile you're saying, I had this and it failed, and I tried this one and it failed. That's something that's different from a typical person here in the ecosystem. This kind of embracing failure as a learning and getting up and starting something new again, and actually almost understanding that this will bring more experience to the second and third try, versus here it's more it's less forgiving, so to speak.
Yeah, زي ما as we say in here or specifically in Egypt التالتة نبتة. So
Yeah, yeah, تالتة تابتة. Yeah.
تالتة تبتة.
Third time's a charm, right?
Yeah, yeah.
Exactly.
So yeah, not
Yeah,
celebrating failure, by the way. So there was a big debate a few years ago on celebrating failure or not. I am not celebrating failure. I'm not saying, hey, I should fail to learn and I'm proud of my failures. No, I'm proud of my learnings and I'm accepting failure
exactly.
as part of the journey. It's not good to fail, but
Absolutely.
if it's part of the learning curve, a part of the learning journey, why not?
Yeah, it's not being proud of them. It's more just being transparent
Accepting,
and
yeah,
normalizing
yeah,
them. Yeah,
exactly.
yeah,
Exactly,
exactly,
normalizing them and accepting them as part of my learning
exactly.
journey.
Yeah, the point is not to be happy about it. The point is
Yeah,
to
exactly.
see it as normal, as something that
Yeah,
can happen.
yeah,
Because when you take big risks and big shots, you can also have big misses, and that's the nature of the
exactly.
beast. So, I mean, drilling down into decap, according to your profile, I mean, it was a 1 year experience, only 4 months of which was full time. In the beginning, you were still at Carta, and so it was actually quite a quick decision to decide that you're going to close it, and that's pretty hard for many founders to make that decision. So, can you tell us more about what happened and how you came to make that decision? What your criteria were for deciding to not continue with it?
Yeah, so multiple things. First, we were three co-founders and we created the system that would do automatic rebalancing for crypto hodlers, as we used to say. We launched the product, we tried promoting it, and as you know, crypto is ups and downs. And when it's an up, everyone wants to invest in crypto. If it's a down, nobody wants to talk about crypto. Not even not invest, so not even talk. So I think we hit a down in the market and it was very tough to get users. That's one thing. The other things, the other thing was the dynamics between the founders didn't really work. So we had disagreements, and some people accepted other jobs. Some people were like I'm still very good friends with one of the co-founders. He got an offer by a huge company in there to get his master scholarship for his master's degree and work for them. So with those two things, master's degree and the full time job, he said I can't, you know, I have to accept that offer and I can't work for you guys, work with you. Um, so yeah, it's life happens.
Yeah,
We tried, and yeah, the decision was common between all of the founders. Okay, it's not working and we can't stay together, so let's just drop this thing.
got it. All right. And you joined Carter relatively early. I mean, when it was still a very high growth company as a data scientist, and you grew inside it. As you said, it was a great learning experience. What was it? What were the key learnings from a growth perspective? What's it like to be in a high growth company in Silicon Valley?
Yeah, I love this question because that was my main goal of joining Carta. In addition to learning more data science on investment data, it's seeing the dynamics between the founder, the investors, the top executive team. I was like number 89, I think, in Carta, and I was a small screw in the big machine, the big Carta machine at the time, and it became even much bigger. And I was like silently watching what's happening and how they think about growing the company. And it was not similar to what I was used to in the MENA region. And even I'll give you an example on the funding rounds. I think I was there for two or three funding rounds. maybe two funding rounds. For the second one, it was so easy and so quick. I mean, I'm not discrediting the effort that the founders did to raise the round, but because compared to the earlier days of Carta, and Henry, the founder, the CEO, talked about this in a blog post. I think he faced more than 100 rejections for Carta. He is American, living in Silicon Valley. He had experience in there and starting a company in Silicon Valley with a really good idea for me at the time, like cap table management. Yes, it makes sense. We need this. And it's not just cap table management, it's digitizing that small paper share book that we used to have, like the green share book, digitizing it in a digital ledger. So he faced lots of difficulties raising money for Carta at the time because people thought, or investors thought, that, hey, it's a small market. How big can this company grow?
Exactly.
But he persisted and he kept going, and the company became one of the main infrastructure for investment and funding in the world, not just in Silicon Valley. And other companies started copying their model in different regions, including in MENA and Europe. So I watched that evolution from it was hard to raise, let's keep all the cash that we have, to a point where, no, we need to spend a specific percentage of our funding. And if we're not good in spending it, we're not good in growing.
Right.
So that was a new thing to me. Like, I need to spend fast. What?
You have to
Why?
spend more.
What do you mean? I have to spend more and fast. It's not just spending anywhere, but it's like calculated spending. Because I need to grow fast. That was a new approach for me at the time. What else? I also started because I felt like I can't comment on the way the management is managing the company. We had this approach of trifecta. There is the business person, which acted as the product management, who acted as a product manager person, and then the technical person, and then the salesperson. This is the trifecta. And inside Carta, I don't think they still have that model, but at the time, for every product in Carta, revenue generating product, we had a trifecta. And yeah, so
so
that model was new to me as well.
They have a salesperson. I think that's not a common thing to have in that type of
Yeah, it's a SaaS company, and you have to go out there and sell this product. And of course, we kept hearing about these concepts before, but I saw them in action. Like, for example, a company in the size of Carta, they would go out there and sell a product before developing it. Like, for example, when we started offering services to VCs, like fund admin, we're still developing the product, but we will create those screens and, like screens to create a demo. It's not really a demo of the actual product because the product is
just
not
the user
really
flow with
yet
screens.
Built. And then the salespeople would go out there and try to sell. And whenever there's a sale, they tell them, hey, we're still building this product and we might need your help in building this product. We need your feedback. We're still working on it. We might need, for example, 2 months or 3 months to finalize this and show you a beta version. And then, the ball starts rolling and you get more customers, more people waiting your product that you already almost sold, not sold out, but sold to many potential customers, and people are waiting for it. Another thing that I learned, the dynamic pricing, as I remember now. Henry was still is kind of a philosopher. He loves experiment and kind of fit with my personality of loving experimenting with things. And I was really fascinated by his approach. So, for example, for pricing, The dynamic pricing was basically, hey, I would keep raising the price until I start facing rejections. And this is kind of an indirect way to value put a number on your
Find
product,
out
or
the
to
value of your product.
find out the value of your product, because it's supply and demand at the end of the day. And people started using this product. They really liked it. And then you increase the price, they're still paying, increase the price, they're still paying, increase the price, still paying, until there's a point where, oh, no, this is not worth the money that we're paying. Okay, no, we will object on this pricing now, these pricings or this pricing. So you would reduce. And again, this is one of his philosophies on reaching a pricing point that is fair in the market. And many other experiments. Again, I'm not speaking on behalf of Carter or Henry. I'm just sharing my experience in there.
Yep.
Yeah.
Yeah, I think this is an important point that needs underlining. A lot of founders are underpricing their products.
Mhm.
They just want to sell, and get traction, and so they end up getting a much smaller margin that they could have. And I think it behooves them to actually take a big risks with their pricing, and then maybe decrease if they don't get traction, rather than the
Yeah.
opposite, because
Yeah. Yeah.
the effect on the bottom line can be tremendous. And so I mean that's very important, and I think it's a part that's neglected at the beginning, because people focus on the product and the marketing and all that, and they forget that price is actually the numbers that make the business stick.
A lot of
So
other things, like in
yeah,
Carta. If you want, I can
yeah,
share
yeah.
more about my learn in Carta. So the social aspect in Carta, we had a Friday dinner lunch for everyone in the company. So Friday is the last day of the week there. So on Friday by noon, everyone will start, uh, getting ready to go
Relaxing,
out of the office. What's
unwinding.
happening? Everyone, no. It's not the end of the day yet, but everyone will shut down their laptops and get ready. What's happening? We're going for lunch. What? Everyone? Yes, everyone. We all go for lunch. When the company was small, we all go to one restaurant. But when the company started getting bigger, like group or clusters of people would group together and go to a restaurant, and that's paid by the company every Friday. And that built different kind of
Social aspect.
relationships between the employees and the top executives. Henry was one of the people who would come with us for the Friday lunches. We had one-on-ones. Every week, you have a one-on-one with either a colleague or a manager or a report, someone who reports to you, or someone from another department. You have to have one-on-ones, and those walking one-on-ones. You go walk for 15 to 20 minutes and talk about whatever, either work or personal, or ask them for advice or mentorship or whatever. So they really wanted to create this sense of friendship between colleagues. We're not just colleagues, we started becoming friends. Another thing is being, and that I didn't find here, and I'm still not seeing here in the region, with some exceptions. The norm in Silicon Valley companies is whenever you get an offer to join a company, in the offer letter, you see how many shares you will get, the vesting schedule, the value of your share, and disclaimer that, hey, these are options. You will buy them. You have to pay for them,
Right.
but on a strike price, and then the value of those shares might go up. There are some tax consequences, etc. They explain everything to you. And
Right.
the idea is they give you shares from day one. And most of our companies in the MENA region, you join the company after a year or two, you start asking for ownership, and they would tell you, okay, we will give you something maybe in a year or two. And then you leave the company before you get anything. With the exception of maybe Kareem, of course, they gave offers, shares to many employees there. And I'm starting to see this more and more, but still, it's not a norm in startups. I mean, hey,
Mm,
you're a startup. You're not paying good salaries. You have to retain your employees by giving them shares and giving them a sense of ownership in the company. In Carta, from day one, in the offer letter, I had
right.
all these details.
Yeah, and it's pretty standard, I think, across startups in Silicon Valley, and it's really founders in the region here not doing themselves any favors, because the amount of motivation and alignment and that you get by offering stock options is really additive to the pie. It increases the size of the pie. So just
Yeah,
looking at
exactly.
which how much percentage of the pie you have is really short selling yourself and quite short sighted. And I agree, it's something that needs to be more present in the region. And of course, there are legal, like legislative issues in the region for companies that are based incorporated in the region to do these things, unfortunately. But it's definitely worth the effort. It totally changes the culture. I agree.
There are solutions for all these legal and
Yeah,
regulatory issues.
yeah,
But yeah, if there's a will, there's a way, right?
exactly. If there's a will, there's a way. All right, so that's incredibly insightful, your experience in Carta, and I think a lot to learn for startups here in the region. Um, Going back to your startup that you're working on right now, which is Number, can you tell us a little about it? What's happening there and what the vision is?
Yeah, that's the charm, the third one.
Yeah,
So number is basically uh, let me push like a very optimistic agenda here and say it's WhatsApp killer. WhatsApp sucks for me. WhatsApp sucks. Why? Because I have to share my personal phone number to everyone who wants to send me a message on WhatsApp. I do not want that.
right,
Uh, why do I have to? Like in Jordan, I was surprised when I moved back. I wanted to uh, print something. I shipped my stuff. I'm still waiting for my stuff. I needed to print something. I went to a bookshop here and I asked him, "Hey, I want to print this paper, this document," and he said, "Send it to Khadar's number." And I was like, "Who's Khadar? And what number? And on what app?" And he said, "WhatsApp, this number." Okay, so I sent the document to that person. His name is Khadar. I don't know nothing about him, but he knows my number and he saw my picture, my profile. It's my personal number. It's my even the American number. I still didn't have a local number in Jordan. So all these details. I mean, if Khadr is a hacker, he can get
right,
somehow something, right? That's one thing. But it's also privacy. Like he has my number, he can call me anytime. Not
yep,
just Khadr, but anywhere you go, even inside governmental entities in Jordan, I face the same thing. Send it to this number. Where on WhatsApp.
right,
Even for groups, like school groups. The teachers, all of the teachers here, they have groups where they send updates on the students' classes and everything on WhatsApp groups, and everyone shares their personal phone number. That's one thing, so privacy. The other thing is spam. Like, I want a way to communicate with people where not anyone can send me a message or call me at any time without me knowing them. Like I receive so many spam calls and spam messages on my phone, both the American and the Jordanian numbers, and I can of course block them, but that's the wrong way to think about it. It shouldn't be open to everyone, and whenever I have someone making me causing me problems, I block them. I will keep blocking people all my life. That should be the other way around. It's a closed system, and whoever I accept can communicate with me. Yeah, exactly. So only people you accept or invite or send you invite can communicate with you on number. And also, the third and last main point behind starting number is it's the bigger vision for later on. We always say, and on the website we say it's a neo telecom company, meaning just like neobanks, it's a banking system or platform that is built on top of the banking infrastructure, but it's offering services in a different way. Same thing for a neo telecom company, or this is what we're saying. We came up with this concept on our own, this definition, meaning I want one number as my identification number to use everywhere I go. If I'm in Jordan, I use my Jordanian number. If I go to the States, I use the US number. But what if I'm in Dubai or in the US or in Saudi or in Europe or in Japan? Do I have to buy a local SIM card with a local number to start using it? Yes, I do. But the most obvious solution is, hey, you don't care about the local number. You care about people who add you on Messenger, on WhatsApp. You can call them there. You can call them on Google Meet. You can call them on Zoom, whatever. That's true. But I want a future where I have this global identification number for me. That's my global phone number that has no country codes, that has no old infrastructure where I have to call a country code, an area number, and then the remaining of the phone number. And I can use this wherever I go using whatever SIM card I take from the local country I'm in. So imagine, I'm sure you know the idea of those SIM card marketplaces. There's an app, multiple apps. You install this app and you take an eSIM wherever you go, and then you start using it to use the internet mainly, because you only care about data. So imagine where there's an app just like WhatsApp or Telegram or Messenger where it automatically detects where you're traveling and replaces your eSIM, and people can still call you on that specific number, not on the old infrastructure of the telecom operators, but on the data plans of these eSIMs. And again, once you add that person, you don't care about the number anymore. But when you start looking, when you meet someone in an event, you ask for their phone number. You don't give them the phone number, you give them the number. Anyway, a long answer
Got
to.
it. And the business model is what do you? Is it subscription? Is it a share of the eSIM revenue? How would you?
Well, we talked a lot about the business model of this company, and there are multiple ideas. I don't want to talk about one specific approach or option for now. I'll leave it for later. One of them would be sharing cost with telecom operators. One of them would be selling short numbers or special numbers as a service. Like every year you pay a specific amount to keep this number. But for now, it's free. We don't want to worry a lot about the business model for now. I know it's against the norm now.
Right.
You need to think profitability, unit economics. This is the new trend now in
No,
DC, especially. And
yeah,
yeah,
it
but
depends on the
we
product,
want to.
doesn't it? I mean, WhatsApp was sold for $19 billion and it had no business model. So
Exactly. Yeah.
not every business is the same. And the dynamics here, I think it makes sense to go for
But
delivering the
here's
value and then figuring out how to make money from it.
yeah, the idea is, or the goal is, be one of those neo telecom companies of the future. I think calling apps and messaging apps are the telecom companies of the future. And we want to be one of these future companies in telecom.
Got it. Great. I wish you luck, inshallah.
Thank you.
So, I mean, maybe we can talk about your book that just got published, VC Evolve. It's from what I saw. I haven't had the privilege of reading it, fortunately, but it seemed to me from the table of contents to be like an A to Z of venture capital, including some new ideas around, using data to invest and things like that. Uh, but the first thing that struck me was the name. Why the name VC Evolve?
Yeah, it's basically we're evolving as VCs because I have this idea or concept: venture capital should not be static business because it's investing in innovation, and innovation is always evolving, right? It's in the name. Part of the name is that ever evolving startup frontier, and I started a VC a podcast before the VC React podcast was called, still there, VC Evolve podcast, to talk about the future of the VC model itself. So I host a VC for like half an hour or 45 minutes to talk about how they think about the past, present, and future of the VC model. Some focus on data, some focus on AI, some focus on changing or the evolving legal structure or fund structure of the VC, like a continuity fund, or some talk about the venture studio model, some talk about the accelerators, the move from incubators to accelerators to what next. A lot of things are happening now in the VC model and the VC industry itself. So I wanted to focus on that piece of the industry, the evolution, the continuous evolution of the industry, because we keep investing in an evolving innovation. So that's why I called it VC Evolve. And it's complemented by the podcast, the VC Evolve podcast.
Right.
So you can, after you read the book, if you want, you can also listen to the podcast, which every month we bring in a new VC to talk about the future of the VC industry itself. That's why I want it to be dynamic, not static.
Mm-hmm. Okay, while we're on the subject of writing, I'm really impressed with all the stuff that you've been doing, that you've been across the years blogging, and you have a lot of blog posts, some of which I've benefited from over the years, and now you write a book. So my question to you is, how do you develop this habit of writing? How do you maintain it? How does it fit in your schedule?
Yeah, maybe before we talk about that, just a disclaimer on the book. It's a textbook style. It's not an opinion book. It's an aggregation of knowledge. It's what I wish I had when I started my VC career. But everyone should know VC is an apprentice job. You learn from others, you learn by doing, you learn by investing yourself and making mistakes, and you develop this skill. In addition to, of course, the big part, which is the science part, the data-driven part, the analysis part, all of that. So I'm working on another book that would be maybe an opinion book, but this one is more like a textbook style. You get the knowledge you need to know for venture capital. You mentioned it's an A to Z in venture capital. I hope it is. That was the goal of everything you need to know. But you need to practice, of course. You need to start investing and start working. Now, back to writing. I learned that from my big inspiration for writing when I started my VC career was Brad Feld. Brad Feld is one of the managing partners of the Foundry Group. I think it's in Boulder, Colorado. It's not even Silicon Valley. But he's one of the first VC bloggers. And he used to blog about anything and everything. He just shares his day, shares comments on a meeting, shares his personal life, some issues that he went through personally or in his career. And I learned a lot from him. And I was like, okay, I like writing as a person. There are some people like talking more than writing. Some people like writing. For me, when I want to organize my thoughts, I sit down and write them. That's how I think. I think better when I write my thoughts than when I talk, for example. I know some of my best friends, no, they can't do that. For them, No, I want to talk about something to organize my thoughts. I'm the opposite. Um, and when I was inspired by Bradfeld, I said, okay, let me start writing whatever I learn in venture capital. It's a journey, and I'll start writing my opinion. I know some of these would be stupid blog posts, and some were actually. Some I learned a lot by just the process of writing, because when you want to write about something, you start researching it and learning more about it. And that was my best way to learn, actually.
Yeah.
Like, as an example, when I wanted to write that blog post, VC Funds 101,
Yep.
I wanted to learn how VC funds are structured legally. And I spent months researching this and asking lawyers and talking to people and talking to VCs. And at the end of the day, you combine all this and summarize it for you to organize, everything you learned. But hey, I did all that. Why not share it? And
Right.
I shared it. And it was one of my, biggest successful blog posts, I think.
Yeah, I love it personally. I always come back to it.
Thank you. And it's evolving. I mean, now there are different ways to structure VC funds. Like, for example, the continuity fund, I think it was not mentioned in there at all.
No, it was
Things are,
as far as I can remember.
see, yeah, things are evolving. So that's why, again, back to the book, why VC evolve, because things keep evolving. And my plan is, I don't know, every year or two, I publish a second edition, third edition, or another edition where I
Right.
include new things happened in the VC industry.
So you don't like structure time for writing every week or something like that. You just start doing research and then write something.
Yeah, I work in bursts of energy. When I have some energy for something, I stay up all night working on it. When I don't have that energy, I'm like the laziest person on earth. So,
Okay, are we all? All
yeah.
right. Um, so I gotta ask you about this. Since you have this experience, specific experience in early stage investing, do you really think that data is relevant to the extent that there's hardly any data there? Um, what are your thoughts on that? I can understand, of course, how it's very relevant in like Series A and above, in revenue share, revenue financing, revenue based financing, etc. But at the early stage, does it really make sense?
Yeah, that's a big question. My usual answer was no, because again, you mentioned it's early stage, there's not enough data, but I was proven wrong by a friend in the US. He started a VC firm focusing only on that aspect of the data-driven part of early-stage companies, and he's managing more than, I think, $150 million now. And he started like only a few years ago. What he did was, I want to study the backgrounds of the founders, regardless of what they're actually doing now, but the backgrounds of or what problem they're solving, or the traction they're having, or any of those things that we usually look at. But let me look at the backgrounds of the founders and the key team members in the company, and compare them to other backgrounds of successful founders who made big exits. And look at the networks they have, the education they have. Not necessarily the top tier universities, we're not talking about that, but the industry they're in, the founder market fit, the number of years they're into this market, the network they have, how many potential investors they have in their network, how many potential mentors or experts they have in their network, how many years did they spend in a specific industry. There was, I think, a study in MIT. Please don't quote me on this. I can't remember correctly, but study said if a person works in a specific industry for 1 to 3 years, they know enough about the industry, but they can't really disrupt that industry or come up with a new innovation that would change the face of that industry. They're still new. They're still learning. If you're 7 years and more into that industry, you're already inside the box. the window of innovation kind of closes. But between 3 to 7, this is the window of innovation in any industry. This is where you learned enough about the industry, but you're not inside the box already, so you can innovate, disrupt, create, be creative, etc. So things like that. If you focus on these signals, you might be able to create like a mosaic of things that you look at in the founding team members to decide if they're good in the future or not. Another example is the Founder Institute in Palo Alto. They focus on behavioral tests for founders. And the only thing that they focus on is, will the founders stay together in the next 3 to 5 years or not? And they gave this test to thousands of founders over the past, I don't know, 7, 8 years. And they claimed with an accuracy rate of 98% or something, I don't know, and something in the 90s, that they can predict if the founding team can stay together or not. So that's another example of what data to look at in the very early stages.
But these are like these examples are actually very interesting because the first one might actually increase bias. So if we say that, because it's based on historical data, so if investors come from a certain background and so they tend to invest in people from that background, then the data will say that this background is the best background. But that doesn't mean that the others can't be successful. It just means that they don't fit this bias. I mean, it's not forward looking, it's backward looking, and it emphasizes biases rather than making contrarian maybe decisions that can have very high upside. Like, people like Topi, the founder of Calendly, he didn't raise VC funding because he couldn't raise VC funding as an African American, second generation immigrant. But it ended up to be a unicorn outcome with hardly any funding, and you can see how an algorithm would not have invested in him either. So that, whereas maybe the Founder Institute, it's really behavior. So it's this person in front of you. It's really colorblind, education background blind, country blind, immigration status blind, etc. And so maybe there's no bias there, but there is a danger of having bias if you use
I
data
agree.
in this type of
I
way.
fully agree. There is that danger, of course. There are ways to reduce that bias. If you include a bigger sample, if you try to remove the race, or ethnicity from this, if you focus on the topic of education, not the school that the founder went to. Of course, there's always a bias for Harvard and Stanford and everywhere. But yeah, there are ways to remove or reduce, let me say, not remove, reduce that bias. But I agree, yeah, there is that bias.
Yeah. Yeah, well, anyway, I mean, you were the best person in the world to ask about this. All
I'm
right,
not.
so,
I'm not.
well, I mean, from your background, data and venture, like the intersection of data and venture, not a lot of people have had this focus for such a long time. Okay, I got to ask you about Gen AI. How do you think seed and venture investors should approach um, generative AI startups and in the different layers of the stack? How are you thinking about this?
Seed investors, you said?
Yeah. So in the
Uh,
early stages where things are maybe less clear, because some
yeah,
people are
Ravi,
are saying it's too late. Yeah, go ahead. Sorry.
it has to be deep tech, not an application. Or I mean, if you're asking about Gen
A
AI,
wrapper.
not in
Yeah,
general
yeah.
applications of AI. So now the trend is investing in agents who would use the infrastructure of AI, the LLM models. But if you're talking about the infrastructure itself, the LLM models, the new innovation in Gen AI, I think it has to be deep tech, new research, like coming out of universities, commercializing these new research um, papers or projects that people are working on. I've seen a company only 2 or 3 months ago where they're creating a new technology to create those LLMs. I don't have all the details right now. I wish I can share all those with you, but yeah, it's a totally new technology that would mean things would be smarter and faster and use less resources. Like
More efficient. Yeah.
the resources,
Exactly.
it's way more efficient. So that's something we, I mean, seed investors, if they're interested in that domain, they can look at. But it's not, yeah, it's not the applications of AI. Now, if you're talking about Gen AI, but yeah, I mean, all types of companies could be good. It depends on the founder, the founding team, the execution, the market, of course, you know, all the things that we look at.
Yeah, but do you think it's any upside from like applications that are wrappers over an existing large language model are not really worth investing in, are not venture scale like outcomes? Is that what you're
No,
saying?
don't get me wrong. No, no, I'm not saying that. But if you're looking for the next ChatGPT or the next Gemini or Copilot, you need to go look at the
Yes, of
deep tech
course.
technologies that are being created right now in research labs and universities. That's where you look for them. Sorry, maybe I misunderstood your question, but that's what I mean. If you're looking for the next GPT, ChatGPT or OpenAI, you go there.
You go to the university, so to speak, or to this. Okay. As I think about the region, going back to our region, what do you think are the most promising verticals in the region?
The sexiest I can tell you is fintech. um, Everyone wants to be
The
in the fintech
fashionable one.
and the fashionable one. And we talked about this in the latest episode where we have so many payment companies, so many um, peer-to-peer payment companies, payment gateways, wallets, digital wallets, neobanks, wealth management, savings management, personal finance, a lot of things that are just copies of each other. So many of them, so many of them. And as we were talking, many of these would either merge together, consolidate, or just die out. And a few winners will surface out. What other things that the region needs?
So in your opinion, is fintech too like it's too competitive for the really best outcomes, or does that mean that fintech is worth investing in the region?
It's worth exploring, and it depends on your stage. I mean, if you're a growth stage, you can pick the winners, and they're
Yeah,
already there.
of
You
course.
can already tell who the winners are, the big winners, in specific verticals. And some would argue, hey, no, fintechs are not really that good in our region because banks are somehow forced sometimes by regulators to be advanced, unlike the US. Actually, I was with a VC in Jordan a week ago, and this was his opinion.
Mm,
VCs should not invest in fintechs because the competition from banks will kill them. He doesn't think that banks will acquire them. Banks will have to evolve and build their own tech teams and move faster and compete with these
interesting.
fintechs, especially with the regulations, because they have the ability to get the licenses they need
Exactly.
faster than startups. They might acquire those companies because they need the team, the talent, but they can get the license, they have the cash, they have the customers. So, but anyway, so in the region, I think we we missed out on many hypes or peaks globally, and I think we have the talent, and we should focus more on tech investment, like pure tech. We have people in universities who are trying to work on new technologies. Uh, they have some resources, especially in the big universities and the GCC. They have really good infrastructure and resources, and they have really good professors or teachers
Budgets and professors
and
and yeah.
budgets, and they collaborate with international universities, and they have the potential to really contribute in creating new technologies. So instead of us being users of new technologies all the time, we can maybe once create those technologies. And I think there has to be some change in a model. I don't know what. I'm not claiming that I know the answer to this, but I understand the VC model is not maybe designed for this. I mean, I want a business that would create economic value now or in the near future. But if I invest in a technology that would be commercialized in 5 years or 10 years, that's not viable for a VC firm. I don't know what exactly how to do this, but we need that. We need to focus on that somehow. And of course, one of the biggest issues that we will face in the near future is oil. We will not have enough oil in the region. What would we do? And I mean, countries like Saudi, Dubai, the Emirates, and I don't know if Qatar is also doing that. They're trying to diversify their economies to not
Right.
depend on oil sales that much. So anything that would contribute to that vision would be really needed in the region. But again, I've always been talking about globalism or globalization of our startups. I love it when I see a global company coming out of our region. I
Yep.
your question was more about the region. So I gave you that answer for the region. But for
No, I
me,
mean,
as Ahmed,
yeah,
I
building for the
want,
world is something the region should do.
yeah, exactly. That's
Exactly. I
that's what
mean,
I
that's how it
really
should
get
think.
excited about. Yeah,
Yeah, me too. I always like, just think big, think bigger.
yeah,
That's what
exactly.
our founders should do. Yeah. All right. So as we come closer to wrapping up, I mean, if you could go back in time and give advice to your younger self about things you didn't know back then that you know now about investment, what would you tell yourself?
Oh, I don't know. Um, like things that come to my mind would be maybe it's against what I'm doing now, but focus. Because no, honestly, because I used to think about different goals in life, and now although I'm doing multiple things, but it's under one umbrella. But earlier in my career, I had multiple umbrellas that I'm thinking about. So this is me focused now. And I have friends that tell me, "Hey, Ahmed, you're not focused enough. You have to focus more." But I'm like, no, this is my capacity of focusing. I'm focusing on this thing. But I had my family business. I had my engineering career. I had some other business ideas that I wanted to do, and I was lost in between multiple things and life. But then eventually, somehow, um, I found myself maybe by design or maybe by passion, just focusing on venture capital. And when I say venture capital, again, we're talking about the primary venture capital, secondaries and venture capital, RBF, revenue-based financing and venture capital, uh, writing books about venture capital, etc. Um, so startups, VCs, this is my thing,
Yeah.
my passion.
Uh,
Yeah,
yeah, that's why we're here, right? So,
yeah.
um, as we think about like venture capital in the region, obviously, I mean, we need exits for people to have returns on their investments. What are your thoughts about exit opportunities in the region for startups? How things are evolving? Do you have any thoughts on that?
I don't have a perfect solution, but I have something, I'm seeing something that makes me very, very optimistic about the future of exits in the MENA region, which is the IPOs in Nemo. It's called Nemo, not the main market in Saudi. Tadawul, Nemo. Yeah, we have Jahez and we have the other company in Saudi that went public last month or a month.
Yeah, I know the one you're referring to, but also the name can't
Yeah,
just
so we
isn't
have
coming.
two IPOs in the MENA region. We have
Yeah,
IPOs
and quite
outside.
large ones. Yeah, exactly.
Yeah. So I think if we focus on IPOs, that would be a solution, one of the solutions that we can have for the exit issue in the MENA region. And I said that maybe before on other podcasts, but I'm saying it again. Impact 46, they invested in those two companies that went public in Saudi and they helped them go public. I don't know if their focus is pre-IPO companies or they go to growth stage companies and help them go public, but this is a focused VC firm that helps companies go public. And I wish there are many more VC firms like that.
Right. And it's good for the region. It's good for them personally
Yeah,
as
of
a
course. Yeah,
VC
yeah,
firm.
yeah,
Yeah,
yeah.
great. So on the wonderful subject of exits, we can move like to the wrap up questions. Um, what book or books do you like to recommend to others?
Many. But
Other than VC
I
Evolve,
would
okay? I
say,
mean that's not allowed.
yeah. Okay. Zero to One comes to mind for Peter Thiel.
Okay. Uh huh. Okay. How do you unwind and how do you stay energized?
I have these days where I just do nothing. Always go, 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 do, read, write, whatever. But there would come days, like, I don't know, every month or so, I have 1 or 2 days where I just, yeah, disconnect, do nothing, let myself be lazy, eat a lot. Apparently, this is increasing. But anyway, uh, watch Netflix, enjoy a movie, whether it's thriller, horror, action, sci-fi.
Yeah.
Just binge watch a show that I heard about for a while, but I didn't have the time to watch it. But binge watch it, finish a season, and maybe one night or 2 nights. So I give myself room for just be lazy. It's kind of
Yeah.
I recharge, and
Yeah.
I'm in between, like on the edge. Whenever I do that test, introvert extrovert, I'm always in between.
Yeah. Same for
So
me.
sometimes I really do get more energy by talking to people, and sometimes I get exhausted by talking to people. I get more energy by just being alone, and I just go with the flow. I let myself tell me what I need at that time, and just do it.
Yeah, that's great advice to listen to yourself, so to speak. Who do you think we should have as guests or guests on the podcast?
A lot. And I mean, over the past few months since I came back, I met a lot of really good VCs in the region, and I think you would maybe talk to all of them and bring them all, and also some really very smart, brilliant founders. Um, you're more about startups more than VCs, so there are lots of really good founders. But I think we're kind of overlooking, if we want to think global and talk global, we're overlooking the Arab diaspora founders who started global companies from somewhere else outside the region. Because this would be an inspiration for me personally and everyone else, maybe to think global
Yeah.
from day one. Like, for example, the founder of Replit. I don't know if you hosted him
Amjad.
for
Yeah.
Amjad.
I wish, I mean, I'd love to have him actually. I love what he's building. And I love his
Yeah,
general like approach, to be honest.
yeah. And others like the founder of AI Explain, um, and many other founders from the Arab diaspora. And I know it's Startup Arabia, but because there's the word Arabia in it, I would ask you to find founders or VCs who are of Arab origin, but in different regions that we don't know about. Like, I wish to listen to someone who started a company in Japan or in
Yeah,
China and tell
yeah,
us
that would
about the
be interesting.
challenges. And yeah,
Yeah,
I know
and the
I'm
differences
asking
and the
for
lessons.
very hard things, but I think you can reach to these people and get them.
Yeah, hopefully, inshallah. So, what question should I have asked you that I didn't?
I don't have any specific questions. Yeah, I think you've covered a lot of ground and you interrogated me.
Oh, come on, man. So, of course, people can reach you on VCpreneur.com. We're going to have links to all that, and we're going to link to your book link on Amazon. Is there like a preferred channel that you like people to reach out to you on? Is it email, Twitter account you want to share or
I'm
something
very
like
active
that?
on LinkedIn.
Right,
Very active on
LinkedIn.
LinkedIn. So just add, I always accept everyone who send me any LinkedIn request, and after that, you can send me any message. So very active on
Cool.
LinkedIn.
So, on that note, my wrap up question is always what is a gift somebody has given you that has had a positive impact on your life?
I'm blessed and grateful for everyone and along my career. But I think the first one who promised me experimentation, I mean, career-wise, we're talking professionally, promised me experimentation and delivered, and I learned a lot. And that company was Rashid Billah. Um,
Hmm.
that was the gift of believing in me. That nobody who is obsessed about venture capital and who wants to create the Y Combinator in the Middle East in 2009. I said, "Come, let's experiment together." I think that gift of believing in me.
Yeah, that's a wonderful thing. This gift of believing in someone is very powerful and can really change their lives. So we should all do more of it more often.
Yeah,
Yeah.
yeah,
Thank you
exactly.
very much for your time, Ahmed. Really enjoyed our conversation and to many future conversations to come, inshallah.
Thank you for having me. I really enjoyed this conversation.
Thank you, Ahmed.
Thanks.
Thank you for listening to this episode of Startups Arabia podcast. If there was something you really liked about what the guest said today, reach out to them on social media and tell them what you liked. And of course, if you haven't subscribed yet, what are you waiting for? You don't want to miss any of our great upcoming episodes. Also, please rate us and give us comments on our social media accounts so that we know how to improve. And also tell us what you like. We don't mind hearing that either. Until next time, this was your host, Ali's Whale.